Hey, this is Mike from Mike Pair Money. I just want to go through and talk about several different topics as it relates to money. And from there, just explain what some of these terms are. So you have a budget. What is a budget? A budget is just a means of tracking what you have coming in and going out each month in terms of how much income do you make, money coming in, and what your expenses are going out. And next, you have emergency fund. Emergency fund is once you know how much your monthly expenses are, you want to save between 3 and 6 months of monthly expenses, such that in the case of emergency, if you're not receiving a paycheck or your income stream have been altered in some kind of way, you can continue to survive. Next from there, then you have tithes. What are tithes? Tithes is basically giving to your local church 10% of your income. Now, there's a debate that some people may give according to their gross or their net, but that's up to you. Next, we have disability. What is disability? Well, disability is a type of insurance just in case if you get injured on the job, you can still have income coming in. And sometimes these programs are offered through your employer, or you can go out and buy a disability policy as an individual yourself. Next, we have savings. Now, there are many different types of savings, but what is savings? Savings is taking some of the income that you have earned and stashing it away by putting it in an account. Sometimes they're savings accounts. Sometimes people put them in high yield savings accounts. But I also like to think about savings as it relates to buckets. So what are the different buckets do you have for savings? You could have savings for college, could have savings for buying a new car. You could be saving for a home. You could be saving for your retirement. You could be saving for all types of events. So savings is another thing. So those topics cover what I call the basics or the foundations. Next from there, let's talk about a little bit of growth. So you may do some investing or you may do some trading. So let's start with investing. So what is investing? Investing is taking some capital that you have set aside and you buy something with the prospects of it increasing in value. So one thing you could buy is you could buy a CD. What is a CD? A CD is a certificate of deposit. Basically, you take a lump sum amount, which is called your principal. You can take it to the bank and you can buy a certificate of deposit. With that certificate of deposit, what the bank will do, they'll say, hey, for this amount of money that you're giving us as a loan, we will pay you interest on it. So what is interest? Interest is just amount of money that you earn based on a percentage basis over a certain amount of time. So for instance, for a certificate deposit, you could have a 1-year CD that pays 4% interest. So for every $100 invested, it will pay $4. That is the interest rate. And then the length, that is usually the duration of the CD. So that is a certificate of deposit. Now, similar to a certificate of deposit, it's kind of like a high yield savings account. The difference between the two is a high yield savings account typically doesn't have a duration. You put your money into this account. There's a agreed upon interest rate that it pays you. And as long as your money is in that account, you'll receive that interest amount. And typically they pay on a monthly basis. What's good about these high yield savings accounts is that they pay more money on an interest basis than what you would get if you just left your money in the bank in a regular checking account or savings account. Now, next, we have this thing called bonds. Bonds very similar to a CD, but bonds usually are issued either by governments or corporate entities, but they still have the same things. They just change the names a little bit. So you have a principal amount that you contribute, and then the interest that you get on a bond is typically called a coupon rate. But it's the same thing. It's an interest amount that you receive. And usually your bond has a holding period that you have to hold them for. And then your money is returned to you in terms of your principal amount after the duration of that time for the bond. And there are several different types of bonds, but that's just the basics of how bonds work. Now, let's talk about mutual funds. Well, what are mutual funds? Mutual funds is really like a basket of companies that have been put together. And as opposed to buying one individual company, you'll buy several companies in a basket. and that's a mutual fund. And there are companies out there that sell these, and there's different types of mutual funds, but effectively that's it. You buy a basket of funds, and when you invest in them, as opposed to buying one, they buy a collection of them. And then as each of those make money or lose money, the average of their performance is what you earn as an investor. That's a mutual fund. Now, after mutual funds, you have these things called exchange traded funds. They're like mutual funds, but they have a little bit more liquidity. Basically means that you're able to get your money in and out pretty quickly, and you can trade them more frequently. But the concepts are pretty much the same as a mutual fund with a exchange traded fund, or a lot of times they're just referred to as an ETF. Stocks. So you heard about stocks. You hear people talk about stocks, but what are stocks? Technically, stocks is just really an instrument that represents a fractional ownership in a company. So let's say Apple, right? You can buy a share of Apple stock, and what that share is traded on the market. And as a result of it being traded on the market, it goes up and down. The price is not static. And so because of that, you can buy stocks or trade stocks. And if you buy them lower and sell them higher, you make the difference between the two. So that's really the basics. There's much more to stock investing than that, but just at a very basic level, that's what a stock is. A fractional ownership of an amount of a company. Now, let's go on to insurance. So what is insurance? Technical definition of insurance is a tool to manage or mitigate risk. So, for instance, you hear about different types of insurance. You have life insurance, you have health insurance, you have disability insurance, you have long-term care insurance, you may have business insurance. And the purpose of all of these is if there's something at stake, you want to insure it. And in the event that something happens, for instance, life insurance, if someone dies, then that person's life is covered and there can be a payout, death benefit payout to beneficiaries if that person dies. But everything is not just about dying. You can actually have health insurance. If you get sick, then you want to be able to have some health insurance, again, to cover the risk of that cost, and you transfer that risk over to the insurance company. And in exchange for premiums, that's the amount that you pay to cover for these, then you would receive that health insurance benefit. There are other types of insurances as well. You have disability insurance. I spoke a little bit about that earlier. If you get injured on the job and you're unable to work, you can have a disability insurance policy that will replace some of the lost income that you have because you can't go to work. And then there's long-term care insurance. Say if you have an elderly parent or a sick child, you can have long-term care insurance that allows for either stay in a hospital, could be stay at a facility, a rehab facility, or a respite facility. Long-term care insurance is to help for that. And sometimes if people have a chronic illness and they need care for many years, long-term care insurance can help for that. And again, you pay a premium for it, and then as you need it, and if there's certain qualifications that you have to have in order to be eligible for it, but once you get it, then they will pay out to help incur the cost of the expenses that you may have. So that's long-term care insurance. The product is called an annuity. Well, an annuity is really, it's a income stream in exchange for an upfront payment. So say, for instance, say I have $25,000 and I wanted to give that $25,000 to a company. I can give it to a company, and that company will figure out how much income stream on a monthly basis I can receive in exchange for that $25,000. Typically, annuities is a type of retirement product, and you usually use it if you have a lump sum of money. You give it to an annuity company, and then they'll give you a revenue stream. One of the things about annuities is that typically they cover you for your life. So if you buy an annuity contract, again, in this instance, $25,000, let's say they were going to promise me $100 a month, then in exchange for that $25,000, I will get $100 a month every month for the rest of my life until I die, in most cases. So that is a simple, a very crude example of an annuity, but just to help illustrate the point. So let's talk about retirement. So retirement is technically when you've worked for a company a number of years and you reach a certain age and you want to stop working. That is typically retirement. So in the United States, you can retire at age 62. And then for certain people, they have to work to 65. And I think anybody born after 1965, they have to work till 67 to get full retirement age. But when you retire, if you've worked enough years during your youth up to those pre-retirement ages, you'll build up credits. And based upon those credits, the government will compute how much you can receive on a monthly basis in retirement from your Social Security. In addition to Social Security benefits, as you were working, you may have contributed to a company program. And some of the company retirement programs are a 401k. If you're a teacher, you may have TRS, you may have 403b, 457, or another variety of a retirement account. But most of these accounts that are not pension related, just truly retirement accounts, you contribute a certain amount. So say, for instance, if you contribute $100 per pay period, some of these employers, what they would do is they will create a match for you. And what they will do is they'll give you, say, 5%, for instance. So for every $100 that you contribute, they will contribute $5 extra on top of that. And so that is how that your money grows over time. So that is a good plan to have in terms of retirement. And one key about these retirement plans is that if you contribute early and if you stay consistent, and if these funds are allocated to good interest earning accounts, then you can earn a lot of money over the years with time and having compound interest work in your favor. Now, I also mentioned earlier about pension plans. Pension plans are plans that employers set up for their employees that they don't have to contribute to, and the employer actually contributes money on your behalf, and it grows over time. And usually pension plans, and as well as some of the 401ks, they have a vesting period. So you may have to leave your money in there for a certain amount of time or be employed for a certain amount of time before you're eligible to receive those funds. Now, also in retirement, there are some individual retirement accounts that you can set up. You can create a traditional IRA just as an individual, not tied to any employer. You can also create a Roth IRA. That is another type of IRA. But what's the difference between a Roth and a traditional IRA? A Roth IRA is used by monies that you contribute after tax. So let's say you have a paycheck from an employer, you get paid, then you take proceeds after receiving that check and you contribute to a Roth IRA. So that's after tax. Whereas in a traditional IRA, those funds can go in pre-tax. And so those are two different buckets. And the real distinction about it is once you contribute money into a Roth IRA, those earnings are not ever taxed again the way that the current tax system is set up. Whereas when you contribute money to a pre-tax account, then those funds will be taxed later on. So that's just something you have to be mindful of. Now, one other thing in retirement that you have to be mindful of is how are you going to pay for your medical benefits? So in the United States, there's a program called Medicare. So Medicare is a group health insurance for seniors. And typically they start at age 65, you're automatically enrolled. Well, you have to enroll into it. There are some dates that you have to be mindful of. But all in all, you get into the Medicare system. And typically there are 4 pieces of Medicare. And sometimes it's really confusing, but I'll try to make it simple as possible. You have 4 parts. You have Part A, which covers hospitalization. Then you have Part B, which pays the doctors. You have Part C, which is like a supplemental portion. And usually there's a 20% copay that you have to pay for that. And then there's a Part D, which is called drug prescription plan. So if you go to the doctor, he prescribes you some medication, then you need to have Part D. If you don't, then you have to pay for that out of pocket. Now, I mentioned that there's a Part C. So in all of these cases, Medicare typically covers around 80% of whatever these costs are. And then that last 20% is your responsibility. But there are plans that are called Medicare Part C or Medicare Advantage plans that actually help you to cover the expense of that 20%. So you can buy one of these plans as well. So that's Medicare at a very basic level. Now we're at our final part of this, and this is called estate planning. So estate planning covers many different areas. You have investments, insurance, taxation, legal pieces, healthcare portion. So let's just kind of walk through each of these and talk about some of the benefits or some of the elements of an estate plan. Okay, I mentioned in estate plan, you have taxes. You have to think about taxes in several ways. I mentioned earlier in the retirement portion is that part of estate planning, when you go to start to take distribution from your retirement accounts and brokerage accounts, you have to think about what type of tax bucket that they're in. Are they in a pre-tax? Are they in a no tax? Or are they in a post-tax situation? Certain accounts, like a 401k, that is a pre-tax. So when you withdraw money, you have to pay taxes on it because it grew all of those years prior without any taxation. So you have to pay taxes there. If you have a Roth IRA, that is, you pay money with post-tax. So any funds that you withdraw out of there, they aren't taxed in the future the way the current laws are set up. And then you have taxable accounts. These are like savings accounts, brokerage accounts, and things of that nature. And then they're taxed at your normal tax rate for whatever your income is. So those are three things that you have to deal with in taxes. One other thing is taxes after death. When you die, if you have certain property that you haven't transferred over to your beneficiaries, in some cases, certain assets can be taxed that your beneficiaries are going to be responsible for. So that's something that you need to be mindful as well. Another element of estate planning is insurance. And usually it's life insurance, but there are many different types of life insurances that you can have. You can have just a life insurance policy for you. You can have a joint policy for you and your spouse. You can get riders for your children. You can, if you own a business, you can have insurance policies for your business partners. You can have survivorship insurance, where if something happens to you, then you can actually have an insurance policy that covers your wife if you precede her in death or vice versa. And so insurance is a huge area within estate planning to ensure that you're making and protecting your assets, and that what you mean to leave for your heirs will properly be distributed to them upon your death. Another aspect of estate planning is your health care. How are you going to deal with health care? We talked a little bit about it in the Medicare portion, but also you have to think about long-term care. So in the event that you become sick, do you have funds set aside? Do you have insurance policies that govern how care will be provided for you, and that you have the funds set aside for that care? Do you have health care that was provided by your previous employer? If you're, and we talked about, you could be after 65 that you're automatically participating in the Medicare program. So things about health care are areas that you have to plan for, and just don't leave it up to chance. As well as long-term care. Should you become injured or ill and you have to go into a facility, then what does that look like? In addition to that, what are some of your healthcare directives? So if you got sick and you couldn't make decisions around what you want to happen to you, well, what have you put in writing to say, hey, in the case that I'm incapacitated, maybe I don't want a feeding tube. Maybe I do want a feeding tube. Maybe I don't want to be on a ventilator. Maybe I do want to be on a ventilator. And so you can have a lot of your wishes put in the writing, such that that won't be left to your family members to have to choose between how they want your care rendered. So these are healthcare directives. Also, you want to have power of attorney. Who do you want to act on your behalf to control your financials in the event that you're unable to make decisions because of your health condition? These are also things within the legal portion of estate planning. Another piece of the estate planning puzzle is asset distribution. In the event of your death, how do you want your assets distributed? Who do you want to have your car, say your house, say your boat, say your jewelry, say certain accounts? How do you want to split them between your wife? What about if you have children? What about if you have a blended family from a previous relationship? All things of that nature. What about if you have minor children? You need to have guardianship information just in case if something happened to you, happened to your spouse. Who's going to take care of your children? What kind of funds will be set aside for your children? So these are things that you also have to think about in the estate planning phase. Last but possibly not least is beneficiaries. So for any accounts that you have in estate planning, who are the beneficiaries of these accounts? Because some accounts, they pass over automatically if you have a beneficiary on the account with you. If not, then you may actually have accounts or assets that are in your name only, and then they will go to an estate. And then when they go through a estate, they may have to go through a legal process called probate. That's why you may use a trust to avoid some of the probate, because it can be costly and time consuming. But again, these are just other things that you would need to account for in talking with a lawyer around these estate planning things, particularly from a legal perspective, to ensure that you have everything in order. So I hope that this has been a good overview around the different types of accounts and things that you need to be mindful of as it relates to money. Money is a long game, as I always say, and there are many elements to it. And so being as informed as possible as you can will help you to protect and understand what your options are and what you can do. So this is Mike from Mike Pair Money, and I cover personal finance, wealth building, insurance, as well as some retirement-related products and services to be able to help you with information such that you can make the right decision. So hopefully you found this informative, and thank you. This is Mike from Mike Pair Money.